Welcome to another episode of the Portfolio Fix, a podcast from AAM. In today's episode, we're going to talk about convertible bonds and that market's outlook. Whether you're a seasoned convertible investor or just curious about this asset class, there will be something in here for everyone. My name is John Balsamo. I am a portfolio manager here at AAM, and I'm joined today by Gene Pretti, CEO and CIO at Zazove Associates. Zazove has been a partner to AAM since 1992 and manages convertible bonds for our insurance clients. This recording and other similar content can be found on our website. Gene, welcome. Excited to have you here today.
John, thank you.
And Gene, let's just dive right into it. We're recording this Wednesday, March 26th. The S&P is down a little under 7% from its all-time highs in mid-February. How are convertible bonds holding up?
In general, they're holding up extremely well. I think probably the nuance to the markets being down is sort of the reversal that we've seen of the trends from the last year or two, where you had a very narrow rally within the stock market. Obviously, everybody knows about the Mag 7 and how that was driving everything. A big part of the correction so far this year has been in those kind of momentum, extremely large cap names. The broader markets held up a little bit better, and our portfolios generally are positive year to date. So this is one of those time periods where you can kind of see the protection of convertibles protecting on the downside, and maybe a little more subtly diversification all of a sudden working a little bit.
Are there any areas or sectors where credit spreads have widened and that bond floor hasn't held up well?
A handful. Kind of the notable areas, and we'll probably talk about this a little bit later when we talk about issuance, but one of the enormous areas of issuance within the market over the last quarter or two has been within, broadly speaking, the crypto space. And we definitely, with Bitcoin falling pretty substantially year to date, we've seen spread widening in that sector, which probably isn't surprising. Away from that, a little bit of spread widening in kind of the greener, some of the EV related things, batteries, et cetera, some of those sectors. And then to a much lesser degree, a little bit of widening in some of the, what we'll call headline related sectors, whether it be tariff or government spending, areas such as that I would characterize that as being relatively minor. In our portfolios, given the skew that we have towards higher credit quality, most of these things have been unimpactful. We'll use that term.
So is it safe to say that you've been steering clear of some of those sectors that you mentioned?
Yeah, we consciously, particularly the crypto, that had become an enormous area within our marketplace. Some of you all may have seen the stories regarding MicroStrategy, which is a company that literally is issuing equity and convertibles and debt and using the proceeds to buy more Bitcoin. So when Bitcoin was going up, it was a virtuous circle. I believe in total, they've issued over $5 billion worth of convertible securities. And, depending on the indices, at some points in time, it's been a pretty big part of the overall indices. So that's an area where we're just consciously staying away from. It's not a commentary on Bitcoin. The problem that we have with let's pick on MicroStrategy is the credit quality is incredibly correlated with the stock price, which is correlated with Bitcoin. So if you do get into an environment where Bitcoin were to fall substantially, the whole cap structure could kind of implode. So it doesn't have the downside protection that we're looking for in that kind of a name.
MicroStrategy that's an interesting situation that's going on.
It is a fascinating sort of alchemy that, give or take, the stock price trades at double the value of the Bitcoin holdings.
I like that alchemy. I'm gonna write that down for later. So you touched on market breadth a little bit. Do you see any similarities in the convertible market today than you did in that kind of 2000s to 2002 market?
For sure. That you'll recall that you had a very similar phenomenon in 1999 to what you saw last year. That then it was obviously the internet bubble. arguably it was a little bit broader in terms of the number of names that were going up, but you had these exponential moves in names that were related to the internet and technology, broadly speaking. And the broader market just didn't participate. And that parallels pretty substantially with what we saw last year in the market, where obviously NVIDIA was the poster child. So you saw enormous moves in everything that was kind of AI related. The broader market did not participate much. And then thinking globally, the rest of the world, those markets didn't participate either. That the U.S. and a very narrow section of the U.S. was driving everything. We've kind of seen a reversal of that year to date, where the broader market's holding up a little bit better, and the notable weaknesses in some of those momentum sectors. There's fits and starts to it, and we had a handful of moments last year where it felt like this, that it was starting to reverse. But this one feels a little bit bigger right now.
And going back into how we started this about the market and all the volatility that we've been seeing everywhere, has this rising volatility helped valuations?
Yes and no. It's kind of interesting that when we talk about volatility, one of the just kind of oddities within the marketplace is if you look at the VIX as a measure of broad market volatility. Generally speaking, it has stayed very low. You've had a couple of spikes recently, and that has been decidedly differentiated from the single stock volatility that we're seeing. So within the convertible market, we kind of just wrapped up earnings season here, and the number of names where you'll see 15 or 20 or 25% moves on a stock price based on an earnings announcement or a broker upgrade, those type of things, is staggering, which is very inconsistent with what the VIX was doing. Generally speaking, if you look at convertible valuations, and remember, when we're pricing volatility within a convertible, we're generally talking about a little bit longer term volatility. So it's 3 to 5 year type volatility, and generally speaking, the convertibles aren't reflecting the the implied volatility is higher certainly than the VIX would imply, but not as much as you're seeing in single stocks. So there is kind of an arbitrage there.
Very interesting. Always interesting hearing about that volatility and how that affects the convertible bonds in general. One of the big stories of 2024 was issuance, very big issuance. Do you expect to see that continue this year?
The short answer is yes, and a handful of things driving that. I should say, backing up, that year-to-date issuance has actually been really slow relative to what expectations were. And I think what was driving that is the volatility and the weakness you were seeing in the marketplace overall. So I think to the degree that markets calm down a little bit, that'll be conducive to issuance going forward. The other big driver of issuance that I would expect, and this is a more certain thing, is you'll recall that the biggest year of issuance that we've had in decades was 2020 in the midst of COVID. The vast majority of that paper was 5-year paper that was issued in 2020. If my recollection is, it was on the order of 120 billion in our marketplace was issued. So that paper is all maturing. So there will be a fair amount of refinance coming out of that. I think the other similarly related is you had an enormous amount of high yield issuance or straight bond issuance that came in 2020 as well. A lot of that paper is starting to mature, and given the move that we've had in rates from then to now, particularly in the high yield market, you're talking about much, much higher coupons. So the convertible markets, particularly given the strength in equity prices, broadly speaking, the convertible market's a pretty conducive environment to refinance that paper at attractive rates.
You just touched on coupon income, and I wanted to talk about that. With these rise in interest rates considerably higher from those post-COVID lows, how has that affected the convertible market and portfolios in general?
Yeah, and that's kind of been one of our sales pitches lately is if you look over the last few decades, or let's step back even further. If you go back 35 years or so, if you look at our returns, and remember our goal is to get equity type returns, do it with less risk. And for years, income from the convertible portfolio was on the order of 30 to 35% of the total return of the portfolio. For the last decade or so, that number's been more around 10%, just because there were no coupons. Particularly in higher grade portfolios, you were dealing with coupons that were, sub one in many cases for investment grade paper. So now that the yields on our portfolio are kind of pushing more towards the three range, number one, that enhances our total return, obviously. That, the higher that yield is, the higher our expected return going forward, which is a good thing. But the other part of that is it actually reduces our volatility a fair amount. Having getting back to the world where a third of return or so is from income, that stabilizes returns over time. So net, we should get higher expected returns, lower volatility. That's a really good thing. Something related to that has kind of, in addition to just rates being higher than they've been for the last decade or so, the other subtlety within our marketplace is we've seen a surge of issuance, particularly from the utility sector. And the nice thing for us about that paper is because utilities, generally speaking, are lower volatility entities with high dividend yields, the coupons that they issue in the convertible market for very high rated paper, give or take triple B plus A rated paper, you're talking about coupons that are in the 4+ range for a high grade paper, and obviously that's a nice anchor for our portfolios, as well as a really good diversification. That it's a sector that we haven't had. Interesting side note is just the conversion, if you will, of utilities for years, particularly electric utilities, had been viewed as a very sleepy business, very slow growth, kind of GDP, give or take. And with the advent of what's going on in AI and the need for electricity demand to kind of supply the massive data center, and when you kind of look into these numbers, they are staggering. All of a sudden, these utilities are viewed as growth entities, which might be kind of accurate. So it's a nice combination in the convertible market to get that high yield, high credit quality, and the stability that you kind of get from that sort of a sector. Diversification as well.
Oh, very interesting. Well, I can't let you off the hook. I got to ask you at least one politics question. How are you thinking about tariffs and this new Trump administration as a convertible investor?
So the analysts go through all the names and try and discern what the landmines are out there. Generally speaking, the market is, I would argue, overreacting to headlines, and whatever the reality is, we'll find out. There's, aside from tariffs, right? I mean, there's some of the direct, what does it do to cost inputs? It's a very complicated business in terms of where are the tariffs, what are they on? Interesting example is oil imports from Canada. That certain of our refineries need that Canadian oil. We export oil in other places to offset that, but if you were to put a substantial tariff on incoming oil, that would have a dramatic impact on things. So there's a lot of moving pieces like that. I'll offer you some subtleties that people maybe aren't thinking about, that we're kind of combing through the universe to get our hands around this. But one of the big ones, a big sector within our market is software and services. And there's an enormous amount of that business is government business. And you've probably seen some of the stories where, Elon has talked about where he goes in some of these agencies and there are thousands of software licenses that haven't been used in years. Those obviously are going to get turned off, probably ask for a refund. There's some of the, and again, these are high multiple, high growth companies. If all of a sudden a big chunk of that growth was government related, you could see volatility in that sector. So we're kind of getting our hands around what percentage of all these businesses are government related businesses. It's sort of sticky kind of stuff, and what the impacts might be there. But similarly is healthcare. Obviously, another big sector within convertibles is healthcare. A lot of moving pieces in healthcare. In fact, today they did reintroduce a prior Trump proposal to go to most favored nation pricing on drugs, which my view is it's a brilliant idea. That Germany pays 30% of what we pay for a lot of drugs. Making that most favored nation would be a great market solution to even out drug pricing, but the impacts on specific companies could be pretty dramatic.
Well, yeah, we wish you luck in steering clear of those landmines and digesting those more, of course. I'll ask you one final question here. As you look further into this year in 2025, what will convertibles performance hinge on?
The answer always is what do equities do? But I'll expand that a little bit. And I referenced this earlier, that we've been in an environment for a handful of years now where the equity strength has been extraordinarily narrow. And to the degree that we start to see a broadening of equity participation, and we're seeing that somewhat this year, and it's sector based, it's individual name based, it's capitalization based, but it's also international based. That we're starting to see non-U.S. markets firm up a little bit after lagging for years as well. So that would be the biggest headwind. Obviously, the potential blind sides out there are geopolitical, as they always are, and what kind of we'll reuse the word landmines that you could see out from the geopolitical side, whether it be it wouldn't necessarily have to be war-related things. It could be counter tariffs or other kind of oil price spikes or that type of stuff. Again, part of the way we think about this is the easiest and so far obvious impact is you see volatility picking up as there's just a lot of news flow and a lot of moving pieces. All in all, that's a good thing for convertibles. That, again, given our high credit quality skew, we've got that protection of the bond floor. So if something goes against us, we're protected on the downside. If stock prices rise or somebody benefits, we participate on the upside. And to the degree that we see more breadth in the equity market, that's kind of my Christmas wish, I guess. We'll put it that way.
Oh, yeah, absolutely. Well, this has been a wonderful conversation, Gene. That's it for today's episode. A huge thanks again to our guest, Gene Pretti, for sharing some great insights on the convertible bond market. Gene, thanks for hopping on the podcast today. And again, I'm John Balsamo with AAM. Thank you.
Thanks, John.